Afternoon. It's just ticked over in Queensland here. And for those in New South Wales and Victoria, this is one of our first webinars with daylight savings that has added an hour to your clock. So welcome everyone this Arvo. I'm pretty pumped to be sharing this topic with you, all about becoming SMSF millionaires. And so good to see some familiar names on who joined in already. So yeah, wow, there's quite a few familiar faces. So thanks for dialing in during your lunch hour. Now, I did have a bit of a poll on the screen, which a few people have answered so far. And I've got another one coming up, but just a quick share in terms of where people are joining in from. 50% in from Queensland. We've got a third from New South Wales, 10% from Victoria, and 5% from ACT. There you go. Really cool. Thanks for everyone who popped a vote in there. Also, I've just got another poll as well while I run through some sort of introductory slides that just asks, do you have a self-managed super fund? So I'd just be interested to know whether we've got more people kind of who have one and just want to get more out of it, or who don't have one but might be exploring. Geez, that's a clear leader I can see on my screen so far. We've got 60%-ish right now who already have a self-managed super fund. So very cool. But I'll just leave that up there because we will have a few more people join as we go. But just to kind of let you know about what's coming up on our webinars and workshops, we do have our next Wealth for Life workshop, which we only had one, I think, last week. But our next one is on Friday, the 14th of January. Rose has popped the link in the chat box. Thank you very much. All about, I'll kind of explain how this links into our topic this morning anyway. But SMSFs play a big component in our clients' wealth creation. So, but we do have a broader focus on wealth in our Wealth for Life workshop. So if you want to know more about that, then click on that link and see if it might suit you there. Also very related to what we're sharing today is all about estate planning and asset protection. So I thought I'd do a specialist almost webinar focus on this stuff because of what's going on for the last 18 months or so. Not necessarily the estate planning as a focus, even though death is a reality of life, but more the asset protection side of things. So just how can business owners protect themselves in a world where sometimes we don't have a say over whether we can open the doors or not. So yeah, we're going to cover why proper estate planning and asset protection is overlooked, and how your estate may be worth way more than it was a year ago. The risks to business owners and why they've gone through the roof in recent times, and an estate planning overview, including the documents required. And it's definitely not just a will. Estate planning is not a will. So yeah, there's a specialist topic we're going to go in. That's actually next week, same time. So 12 if you're in Queensland, 12 noon, or 1 p.m. if you're New South Wales, Victoria. So again, link in the chat box if you do want to register for that one. And a reminder for our webinars as well. It makes my life way more easier and fulfilling and enjoyable if we're having a chat. So please pop in any questions you've got in the chat box or Q&A. I've got both open there, so I shouldn't miss any. So please feel free to pop in some stuff as we go. Keep this pretty interactive. Also, I thought it might be worth mentioning that we've actually got quite a few SMSF webinar recordings already. So we love super. Rose has popped the links in, so you don't have to type each of these in if you don't want to. But we've already got some specialist topics we've recorded. The first one here is how to buy your office, warehouse, or clinic using your super fund. We've got one on structuring property developments. That's a bit of a love from me. So we've got tons of stuff in there, and then getting the most out of your SMSF. So targeted for people who have an existing super fund already, but just want to get maybe a bit more out of it. So, yep. And then a bit about me. So that's me. I'm Ben Walker. That's a photo of my my wife there, and my kids. So that's actually my daughter, but she grew up in this photo here. Daughter Rose and Ezra. So that's the special people in my life. And in terms of professionally, I've been an SMSF member since 2011, so coming up a decade. I've also dealt with hundreds of SMSFs since I started my career in 2007. So I actually started in a Big Four accounting firm, but the division I was in was actually the small business. They called it SBU. It sounds like crime scene investigation, CSI. But SBU was its name, and we also looked after the SMSFs as well. So I've kind of been doing it for ages now, and yeah, I kind of see with this stuff where there's a will, there's a way with SMSFs and what you want to invest in, or how do you sort of help out your property developments and things like that. It's just a fantastic way to do it. So I've also seen lots of compliant super funds, in fact, most of them, but also some non-compliance and how we've dealt with those in those situations. So yeah, some interesting ones, and maybe if you've got me over if we're having a beer, just ask me about some of those non-compliant ones that I've worked on. Weird and wonderful investments, definitely some strange things in there, but also some sort of run-of-the-mill, basic sort of property or shares and that sort of thing. So yeah, also the weird ones are another conversation over a beer. I've also owned a business through an SMSF myself, and we help our clients do that in the right circumstances as well. And yeah, and account for clients with a combined super balance of over 130 million bucks. So it's a huge amount we look after. But what I'm not as well, I think it's worth mentioning this. So I'm not a financial advisor. So we can't tell you, hey, invest in this, invest in that. But we can say, oh, well, with the superannuation law, how it's written, then you can do what you've asked. Like, if you say, oh, can I invest in commercial property? I can say, yes, you can. And then it's up to your decision and own responsibility if you want to do that or not. I'm not giving you in this webinar specific advice to do something. I just want to make that clear. I'm not going to tell you to invest in a certain class of assets or a certain investment. And I am not giving you enough information in this webinar to wing it. So what that last one there is to do is just to encourage you, if you do want to act on anything here, make sure you get advice around it from someone who knows the rules, whether you go and see a financial planner and get their opinion and their recommendations, or an advisor just to walk you through what you can and can't do as well from what you're thinking. So the rules here are so detailed, so I don't want anyone sort of stuffing it up based on, oh yeah, I heard on this webinar you could do this, but if it's taken out of context, it may end very badly for you. So yes, that is what I'm not. In terms of next steps as well, I'll kind of mention this at the start if anyone's got to take off during the webinar. But the next step, if you do want to consider working with us, I see there's a lot of clients on the call, but if you aren't working with us and you want to sort of have a chat about self-managed super, we do offer a free strategy call with one of our accounting team. Now, all of our accountants who you'll be booked in with have SMSF clients, and they work with this sort of week in, week out. So, and any sort of super specialist stuff, they come and check with me. So, yeah, we know this stuff backwards. So if you do want to have a chat about this stuff, then please book a call in. Again, the link is in the chat box. Sweet. What have we got here? No, we've already covered that stuff. Oh, no, I think it's important. Some of it we have. I've been an SMSF member since 2011. But this bit here, 60% of Inspire's SMSF clients hold some sort of property. I think that's worth mentioning, that property is a huge component of SMSFs, and I don't think it's just our client base, but it's a huge reason why people set them up. And about 28% of our clients have an SMSF. So I think they're sort of two key stats that are worth sharing. Now, in terms of sort of macro level, the ATO released statistics on SMSFs as well, and why I part of the reason why I sort of thought of putting this one together was that SMSFs have become very popular lately. Now, these are stats on the number of self-managed super funds in Australia, and you can see that the tables here are establishments, so setting one up, winding them up. So there's a net number of establishments. and the total number of establishments as well. And then also like a total number of SMSF members. And that kind of says that about 1 in 20 Australians are a member of an SMSF, which is pretty cool. And if you look at these two stats, the average number of members per fund is about 2 members. So that's kind of what I get at. But the interesting thing is SMSF's sort of lost a little bit of popularity, in 17, 18, 19, and even 20. See how those numbers are low, the net establishments. But then in 2021, bang, we've shot up again. That's the biggest net establishments or new SMSFs in a very long time. And my suspicion is that it's actually been a couple of things might have spurred it. Obviously, good old coronavirus, that might be one thing, and the instability of the share market, or potentially even people setting them up to purchase property with the property market taking off. Also, the other one is potentially cryptocurrency. So there are ways you can buy cryptocurrency with your self-managed super fund. Again, not taking it out of context, you need the right documentation in place to do it, but you can do it. It's not a breach of superannuation rules on its own. So all of those factors may have provided the reason why that, even compared to 2020, we've gone fourfold in terms of net SMSF setups. So I found that pretty interesting to see. And the average and median SMSF balance. So, the topic of the workshop is, become an SMSF millionaire, because if you fall within the average assets per SMSF, and keeping in mind that these are an average of 2 members in the fund, then your balance might, if you're in the average, it might be 1.3 mil. So you are ticking over that $1 million. So again, like if we kind of think about what are the sort of wealthier people in Australia doing with their cash, or with their super, to be more exact there, then I would suggest that a lot of them have self-managed super funds as part of their strategy. And what do we got here? Yeah, the average SMSF balance as well. So we've got about 24% of funds that have $1 million or more. So about 1 in 4 funds have $1 million or more in super. All righty. So what we're actually going to cover is, in the webinar, we kind of just did a bit of an intro there and kind of some interesting statistics, but what are we actually going to talk about today? I thought we'd cover these 8 topics. So, why SMSFs in terms of engagement in your wealth creation journey with your superannuation balance. Another one is like having a family fund and what that might mean to your family, how the tax looks in the fund, what we need to consider in terms of the investment strategy with the fund from a compliance point of view, but also like what sort of focus that you need to bring your attention to with SMSFs. Leverage. Now, leverage is in the context of other people's money. So rich dad, poor dad concept, or another way to say that is borrowing money from the bank or other people, and how that comes into play with an SMSF. We'll talk about insurances briefly, incapacity planning we sort of touch on, and I think it's good food for thought when you're considering an SMSF, and also estate planning. So I've kind of got the overview there, and just a reminder, in our estate planning webinar next week, I will deep dive into sort of all the stuff around that. But here's kind of the thought process you need to have on your on your superannuation balance, self-managed or not. Alrighty. Now, just want to check if I could grab a thumbs up in the chat box, or some sort of even if you put your hand up, I can see that in the attendee list, just to see whether we're all good so far. Yeah, that's awesome. Hey, Wendy, so good to see you here. Sweet. Now, I did ask a question: do you have a self-managed super fund? I'm going to share the results there, and thanks, Richard. We are sitting at 55% of people who have voted have a fund already, 36 are no, and 9 are no, but actively exploring it. So that's pretty cool. Thanks, Simon. Sweet, and cheers for those hands. That's good to know we're all good so far. Sweet. So in terms of engagement, what I thought of sort of sharing here is, sometimes I ask a couple of questions to clients and it sort of shows to me, not in a, like, it's not trying to embarrass them or anything like that. It's more just to sort of just assess where their thought process is at on superannuation. But and what I find is often they have difficulty answering it, or at least answering it with any certainty. So just a couple of questions I want you to mull over is, how much do you and your partner or spouse have in super? Like, can you actively recall that rough balance? Which fund or funds is it in? So, I mean, 55% of you have an SMSF, so that might be an easy question. But, do you have more than one fund? And then if you do, why do you have more than one? There may be a reason, but that just might be something you need to tidy up. So there's that one. And then, is the fund making a return you're happy with? So, to answer that question, you kind of have to know a couple of other things, like how much is your fund actually returning you, and are you what sort of return could you get if you managed it yourself? So if you're happy with that or not. So yeah, and I guess from my perspective and experience, that self-managing your own super gives you so much more connection with your, I guess, your superannuation, but also your overall wealth creation journey. Like, it starts to, you start to see things and consider things a little bit differently when you're looking to invest. Sure. Now, comparing your current super to an SMSF. Now, a lot of people ask, oh, how much do I need in super to consider setting up an SMSF? Now, if you Googled that question, the suggestions or the normal range is about $200,000 to $250,000 in super. But the idea that they're focusing on there is breaking even, comparing the costs of your current super to the cost of running an SMSF. Now, a lot of industry or corporate super funds actually charge a percentage of your balance. So the bigger your balance, the bigger your dollar figure in fees will be in the financial year. But if you look at an SMSF, and I've got some pricing that sort of we charge towards the end of the webinar, just to give you an idea, but a lot of it is very fixed fee with a self-managed super fund. So, if you put 500 grand into your super fund as a contribution, rarely would your accounting fee go up in that proportion, if that makes sense. So it's more of a fixed fee for the SMSF. So, but I guess from my perspective, regardless, do you have a good chance of outperforming your current super? So if you're not just looking at the fees and trying to save on the fees, if you go and invest in shares or property that you can't get in your current super fund, you're going to outperform that, or a good chance of outperforming that if you do it yourself. And then the fees become still relevant, of course, but that's not the only thing you're comparing when you're looking to consider setting one up. And the other one on engagement is maybe a bit of a warning rather than a positive a positive thing, or again, taking a bit of responsibility. But the SM in SMSF stands for self-managed. And that might be super obvious, or you've seen the acronym, or you know what it stands for, but it does require diligence to set up and run. Like, it doesn't happen by itself. As an advisor for clients with SMSFs, we're there for a sounding board, and we can assist with certain functions and that sort of thing. But we can't transfer money, we can't make investment decisions and that sort of thing. You need to kind of self-manage that. So keep that in mind. Also, compliance requirements. There are rules of the game with super, and there's big penalties if you stuff it up or you do illegal things. So again, like, you've got to work with someone who can guide you through, what's allowable, what's not, all that sort of stuff. And they do require an annual audit by a third-party auditor. So when we prepare the financials and tax returns for a client, we actually send that off to a third-party auditor, and they give that sort of second check that everything is compliant. So cool, keep that in mind. Cool, Richard, I've just seen your question there. I might answer that as we go, because I've got a topic around that stuff. Cool, so that's the section on engagement and some just more food for thought. Switching into the family fund side of things. In terms of an SMSF, it used to be an SMSF could have up to 4 members. Now that's gone up to, you can have up to 6 members in the super fund. Now, I've got some thoughts on this. So 6 people's balances are better than 1. If you've got an average of 100 grand per person and you've got 2 people in it, that's 200 grand in your fund. You've got 6, that's 600 grand. So it's a lot more money to play with, so to speak. But just some observations on it. I think you need to be careful of a few things here. Well, first one is death. What if someone dies and there's 5 members in the fund? How are they going to manage that dead person's assets and estate when it comes to their superannuation? Disability, and are they going to work together? And especially, going back to death, you can ask the same thing. Are they going to be working together constructively to manage that self-managed super? And the last one there is divorce as well. So even if you've got 2 people in the fund, husband and wife, and they get divorced, they've got to act in the best interest of the fund and each other, which may be kind of understandable, I guess, at the parent level. But the perspective I want to show you is, what if you invited your son or your daughter into your fund and they got divorced, but whoever they were with was also in the fund? Now you've got, you had 4 members. One of them is now kind of being separated from the family. And you need to be very careful with dealing with that situation. So yes, you can have up to 6 members, but there's a reason why I reckon there's an average of 2 members per fund. So it just keeps that a lot easier to deal with in those 3 cases there. And then the kind of another thought on that is, more people equals more decision makers, and people with their own opinions. So that's another layer of complexity. You can reduce this risk by a leading member fund. So we've seen this thing that we can set up now called a leading member fund, where there's basically an overall decision maker if people can't agree. So it's kind of a cool thing to lock in if you do want to take better control and you've got a few more members than just yourself or you and your spouse in there. And you can convert an existing SMSF to a leading member fund as well. So if you've already got one, we can change that and set that up to a leading member, giving you that sort of certainty there. So that is the family fund side. Now, some interesting stuff around tax. So I share this sort of slide or this diagram a lot in our webinars, especially around business structures. But what I want to sort of show you here is that SMSFs have a very low tax environment. Now, under trusts, it says 0% there, but that's because trusts give discretionary trusts give their profit to other entities or people in the family group, and they pay the tax. So 0% is not quite correct there for trust. It actually gives it away. With an SMSF pays 15% tax or 0% tax on the money it makes. So they're much lower than these tax rates here. So that's kind of a high level overview of the differences between the tax rate. Now, why is there 2 rates for an SMSF? The first one is 15% when you're accumulating your balance over the majority of your lifetime. And then you switch into 0% tax when you're drawing a pension and you're over a certain age. So the idea there is that, and sorry, they did bring a rule in as well, that you can only get that 0% concessional rate on up to $1.7 million per member in pension. So if you've got $3 million in your own fund balance, in your member balance, then you can't get that 0% concession on the whole lot. So so do keep that in mind if you're in that situation. And sorry, on the difference, so on the remaining 1.3 mil, if you're in that, if you've got the total of 3 mil in super, you still pay the 15%. So still low. It's just not 0. Yeah, even if it used to be the rule that even if you had $50 million in your own pension account, whatever it earns is taxed at 0%. So it's pretty fascinating. But they have reduced it. Now, benefits of drawing a pension or being in that 0% tax mode, how it plays out, like obviously if you earn dividends from owning shares in super, you'll pay 0% tax on those. But some other instances where we see some cool stuff happen is if you own a business through super, or a part of a business is how that works. Then the profits that go back are actually Sorry, just having a quick gaze at a question there. But the profits that go back to the SMSF in that pension account are actually at 0% tax. And similarly, if you sell an asset, so what we see is you buy a commercial property in your 40s or 50s, hold it for 20 years, sell it when you're retired and in pension mode, and make a massive gain, then you can do that without paying any CGT, which is quite amazing. Now, also what I want to show you, and I'll actually switch screens for this because I've created a Google Sheet that I'll give you access to if you're keen for that. Actually, Rose, could you pop the link for this in the chat box now? But I'll give you a demo. That's my head. Where we go? Going over here. Cool. So what I want to show you is the difference between investing in your bucket company or like a corporate entity outside of super versus investing in your accumulation mode, or if you're in a pension mode as well, and how that works over time. So the green cells is what you can change in here. And so what I'll show you here is the number of people. I've assumed one person, just to show you the power of this. They're contributing, or they've got $27,500 a year to contribute to super or invest in a bucket company. That's kind of the framework I've used. If they put it into super, they pay 15% contributions tax on that. So the net after tax they can invest is 23K. But if they keep it in a bucket company, assuming a 30% tax rate, they pay a bit more tax. So they're only investing 19 grand or so each year. So, and then you can also play with this, the investment return per year. 5's pretty piddly, but again, you can type 8, you can type 20, it's up to you. Cool, I'll leave it at 8. Now, there's also a place you can put a starting balance in just to compare as well. So you can start with 0 if you've got nothing in super, or if you've got 100 grand in super, whoops, that's 10. If you've got 100 grand in super, you can also model that out, comparing that way. So how it works is it basically says, all right, we're taking your 100 grand you've got here, timesing that by 8% return on it, adding in your annual contribution, whether it's the bucket company or the super fund, and we're taking tax out of it as well. So the tax rate's up here. So you can go and adjust this if you're paying less tax in your own name and you want to compare it to that, or that sort of thing. So anyway, what it shows is that after 10 years, we've got an interesting scenario. We've got 1.6 million in our bucket company, which is an impressive amount of money. 10 years for that outcome is pretty decent. Or down here where we've got 1.78, which is a lot more. It's 166 grand more. And again, this is a super basic spreadsheet. You can, I think there's a button at the top. You've only got view access if you use that link, but you can make a copy here and play around with it yourself, change it, do whatever you want with it. But yeah, see how just even in accumulation mode, investing that money through super gives you a better outcome on your balance sheet. And then if you're in pension mode, it's exacerbated, almost double, because of that 0% tax rate environment. Now, if you've got a husband and wife and you're doing it with 2 people, that just doubled the pre-tax contribution. And then we've got starting balance here as well. And you can see that the difference in bucket company versus accumulation mode versus pension mode is massive over 10 years. And yeah, I mean, who wouldn't say no to a few $100 grand on retirement extra? So yeah, that's a compound return calculator, adjusted through 3 different options of tax rates there: bucket company, accumulation phase in super, or pension phase in super. So so that is what I wanted to show you around the controlled tax. I can see a few people in there in the spreadsheet already. Anonymous duck, cool. So feel free to suss that out, and yeah, as I said, make a copy of it, do whatever you want with it. It is not financial advice, of course. I said that at the start. But, yeah, it's just a modeling tool. Cool. So I'm going to switch back to the slides, but I hope that was kind of helpful to just go, hey, this tax environment is actually quite an interesting place. Also, if you're invested in property or you do property development in super as well, your return is likely going to be a lot more than 8% on the money you're investing. So keep that in mind as well. When you might be making 30, 40, 50% on your balance, then that's going to be massive result at the end of 10 years. So yeah. Also keep in mind, we've got some clients who, they might be out and about using their SMSF, and they might get their parents in. So the reason why you might invite your parents into your fund is because they might be in pension mode. And if they're happy going along with the investments that you're making, and obviously you've got to make decisions together, then they're going to be paying 0% tax on their share of the profit that you make. While if you're in accumulation, like I am at my age, I'm going to be paying that 15% tax. So you can bring your parents in if that scenario might work. Again, more people, more decision makers, and all that sort of fun. Hey, Steve, you made it. I thought you're on your own webinar. All righty, just keeping an eye on the questions. Howard, I've seen yours there. If an SMSF wants to invest in offshore investments, I'm guessing like shares and that sort of thing, can we help with the establishment of these accounts? So we don't actually do establishments of accounts like that, but I have heard that there are some exchanges. I mean, if it were me, I'd explore places like ComSec, who do allow you to trade in certain circumstances on international markets. They allow you to do that personally. I'm guessing they might do that with an SMSF one, and that's like their ComSec product. Although I'm not recommending a product, but you know what I mean there. But there should be ways that SMSFs can get foreign share holdings and that sort of thing. I'm pretty sure I've seen it with some clients as well. So it might be difficult, but yeah. Cool. And Ben, yep, that link to that calculator I just shared is no. Thank you, Rose. My control C didn't work. Cool. So Ben, Rose just posted that just below your comment there. All righty. Where are we? Control tax. So now we're going to shift gears into investment strategy. Now, one of the things we need to do for our SMSFs is create and keep updated an investment strategy. And some of the things that should consider is the risks of your investments, like the risk, like it's basically just telling it how it is. If you're investing in cryptocurrency, noting that might be extremely risky compared to leaving it in cash, which also has its risks with inflation, like all that sort of stuff. You just need to basically have a common sense documentation of the risks and why you've chosen that for each of the members. Diversification of investments and benchmarks for classes of assets. So you kind of need to set in your investment strategy, you're targeting 60 to 70% of your fund you want in real property, in property, whether it's residential, commercial, you can specify that. And then you want 40% in cash because you want a bit of liquidity there, or you have to document what you're aiming for to plan that out, and also keep it up to date to make sure that your ranges that you're aiming for is what reality looks like. Now, do keep in mind, if your SMSF holds property and your property has increased in price, in value, then you may have a larger portion of your fund in property, and it may be on the upwards range of your investment strategy. So again, it's important to make sure that your investment strategy is kept up to date with the market values of your fund. You also need to document your intended return on investment. So, hey, is your overall fund targeting the cash rate plus 5%, or an overall return of 20% net of tax, or whatever it is? It needs to document that. Borrowings. So do you want to explore borrowings in your fund, usually with property there? Insurances. So it doesn't mean you have to have insurance in your SMSF, but you do need to document what you've done with insurances. So yes, Ben Walker has insurance in his fund. He's got XYZ insurance because of these reasons. Or no, Ben doesn't have insurance because he's got cash outside in the event that someone dies or whatever. Like, whatever the scenario is, needs to be documented. And then liquidity. So you need to document. Again, it's just sort of common sense or a bit of planning there with liquidity and cash flow requirements. If you're in pension mode, you need to make sure and account for cash to pay out pensions. So do keep that in mind. It's not set and forget. We need to review that each year. Some more stuff on investment strategies. In terms of choice of investments, make sure they're permitted under the trust deed, so the SMSF. For instance, if you've got a 20-year-old SMSF deed, you may need to update that if you want to invest in cryptocurrency, because that didn't exist that long ago. So you need to make sure your investments are not prohibited by the Superannuation Act, and also that it meets the sole purpose test. So sole purpose test is your fund needs to be maintained for the sole purpose of providing retirement benefits to your members or to their dependents if a member dies before retirement. So I remember an example where an SMSF invested in a property on a golf course, and as part of that, this is a really, really crazy example, but as part of that investment, the members got a golf membership to that golf course. And because they had a benefit from that before retirement, that investment was not compliant. So because it didn't meet the sole purpose test, because they might have got a benefit worth a few $100 or a couple of grand in golf membership. So pretty nuts example, but that's where you can see it going wrong. I'm just going to quickly read Simon's question. We have stuff around insurance tool. That is one of the specific modules we'll go through. So I'll get to that shortly. Now, in terms of, actually, no, I'll go back to Richard's question. So if I combine my retail super with my wife's and we buy a warehouse for me to run my business out of, and therefore my business is the tenant, can my business pay over market rates in rent to the super fund? I read that out too early. The answer is no. I'm going to skip ahead. Where is it? The answer is no, and I'll kind of basically with super, you've got to treat, if you're an owner occupier in your own warehouse or commercial property, you've got to pay market rate. So and you need to have documentation of why you're paying that amount. So and no, Steve, you can't do anything different. You got to pay market rate. So how we find out market rate is we usually pay potentially a real estate agent or a valuation firm to go and do a market rate assessment of rent, and then we use that to work out how much the business is going to pay. That should be updated at least every 3 years, but not a bad idea to get it done every year. That sort of assessment. But if market rate rent's 50 grand, you can't just go dumping 100 grand in a year or double the rent, because the ATO aren't silly. They're going to see through that, and that's probably primarily tax driven. So if you do have extra cash to get into super, Richard, there's plenty of other ways than paying that rent. So yeah, that might be a conversation we can have. Cool. Now, in terms of leverage, again, leverage in the context of borrowing money to buy assets in super, the way we do that is through a limited recourse borrowing arrangement. Now, the reason is because an SMSF cannot borrow to buy property directly. So we've got to set up this bare trust, and the bare trust sits in the middle as a shadow purchasing entity. It's really weird. It's all legal. It says shadow. It's not dodgy, but it's just the way it's got to be done. And there's banks that lend to this, so they go through lawyers, so they're not going to do anything. I mean, silly to say banks have never done anything dodgy before, but this is not a breach of SIS Act if you do it properly. But your bare trust buys it with SMSF deposit and the difference from the bank. Now, you can borrow the money from a bank, or you can even borrow the money from your own bucket company. So if you've got, or any other trust or company that you've got lying around, it doesn't need to be a bucket company. I use that example because that's where clients usually have a lot of cash sitting not doing much, and they're surprised to know that they can actually lend that to their SMSF to buy a property and not actually borrow any money from the bank, which is cool. So just throwing that one out there. Now, in terms of borrowing inside versus outside super, I mentioned the LRBA. I'll go on the right side first. We got super contributions, and so when you're looking to borrow inside super, your annual super contributions and your projected rental income actually is what the bank look at to see if you can service the loan. You're going to pay tax at 15% in accumulation or 0% in pension. Very few lenders, even though like it's still pretty easy to get that if you've got the right deposit and servicing. It's typically at a much higher interest rate, potentially double what you get outside of super. But again, there's massive benefits anyway for owning it through super that may outweigh your higher interest rate. The lender can require advice. So there's usually legal and financial planning sign-offs that you might need that the lender can force. But again, that's up to you in the deal you've got with them or the broker gets. It also needs a cash deposit. You can't use the equity in another property. Even if the self-managed super fund owns another property, you can't leverage that equity to buy a second property like you can outside of super. And you also cannot borrow for construction costs unless it's off the plan. So unless it's one single contract. So what I mean there is you can't buy a house and land package where you've got a contract for the land purchase and then you've got a contract with the builder to build a house separately on that. So you've got to borrow for a single asset, they say. Yeah, that is the deal there. Now, in terms of both inside or outside, you can own or occupy in super when it's commercial property. Sorry, this slide was put together in the context of commercial property. And we can see LVRs go to 80%. So usually it's about 70%. Sometimes it's 60% that the bank will lend you. But we can see them go as high as 80% on there. PS, this can all be verified with a mortgage broker, and they can do an assessment of what you can borrow with your current super balance and what you've been chipping in to your super fund over the last couple of years and what your projected rent might be. So they can kind of see, even before you've got an SMSF, the lenders can actually assess if you're eligible or not to get a loan. In terms of the deposit required, it depends on the lender and the postcode and the asset type and the price. As I said, 20, 30% is kind of ordinary. And you need to account for stamp duty as well on top of that. And SMSFs sometimes need 10% of the value of the property in liquid cash for the lender to be comfortable. So they don't want you putting every dollar you've got in your super fund into the purchase of the property and then have nothing to pay the rates bill or the interest bill or the repayments into the loan. So if you've got a 500 grand property in super, they may want you to have 50K sitting in cash after the transaction goes through for them to allow you to purchase that. Cool. Insurances. So Simon's question was around insurances. I may or may not be able to answer it, but I'll have a crack anyway. Again, we've got insurance specialists who help with this stuff. So the stuff I've sourced this from is Money Smart and my own experience. But the type of insurances you can pay for in super are life insurance, TPD or total and permanent disability, and income protection insurance. Now, just generally, benefits of paying insurances through super is it's cash flowed from super, so you don't have to pay it personally. It may be tax effective. So, for instance, there's a portion of life insurance that's usually deductible in super. But if you pay for that outside of super, it's usually not tax deductible. And the cons or the downsides, there's more pros and cons than this, by the way, but I'm just going sort of very high level. The cons is it reduces your super balance, the insurance payments, or it could soak up a lot of your contributions that you put in, going straight to super, going straight to insurance, sorry, when I say payment made to fund, what I'm meaning there is when you're, like, let's say you die and your life insurance pays out. If you're paying it from super and super's the policy holder, then the life insurance payment will be paid to the super fund, not your estate. So it's got to be then dealt with by the fund. And you can get it to the estate if you set it up that way, but keep in mind that there's 2 steps if your wish is to get it into your estate. Cool. Now Simon's asked, what are the implications on bundled insurance premium costs of a retail fund compared with an SMSF? In other words, should I keep a small balance in a retail fund because of that bundled insurance versus getting a whole other policy? Now, Simon, that was actually a benefit that they listed on Money Smart, is that in retail funds, because they buy insurance premiums in bulk, there's usually, it costs a little bit less, but you only get like sort of ranges or a certain amounts that the super fund sets for that stuff. And there may be less hurdles to jump through to actually get that insurance. So I guess this would depend on your circumstances. And again, an encouragement to go and get advice from an insurance broker, or usually financial advisors cover life insurances and that sort of thing. And they can sort of help you with how much your existing fund might be covered for versus how much they recommend you should have. Because, yeah, I know that, for instance, it's probably pretty irresponsible for me to be covered for, $200,000 or $300,000, where my insurance requirements might be a lot higher than that if I was to pass away and not leave my family in a bit of a sticky situation financially. So, yeah, mate, that's just encourage you to get good advice around that. Thanks, Alan. Cheers, mate. I'll catch you around. Sweet. Cheers, mate. All right. Incapacity planning. Yeah, a bit more food for thought. So, if you do lose capacity to make financial decisions for yourself, or another member of your SMSF is in that situation, then please always have an enduring power of attorney in place for every member of your SMSF. The reason why is that your super fund requires all members to be. Jeez. So I'm reading some of the comments in there. I'm not going to disagree, Steve. The super fund requires all members to be trustees or directors. So if you're a member in a fund, you need to be a trustee of the fund. If it's individual trustees, we don't recommend that anyway, by the way. But if it's a company trustee, then you need to be a director. But the director or the trustee can be the enduring power of attorney for the person who's lost capacity, and it can't just be a general power of attorney. Also, you need to make sure the trust deed or the SMSF deed and constitution of the trustee is set up to allow this in the event of incapacity. So again, a lot of the good deeds at the moment should be fine around this stuff, but the bit that you need to make sure is everyone having an enduring power of attorney in place. And you just don't want to be in these situations and you can't access money, you can't invest, you can't sell an asset because you haven't got some of this stuff sorted. And it creates a massive problem that you have to work through legally. And then the last topic, I do have a handful of case studies as well we can run through after this, but last topic here is on estate planning. And Rose, if we can just pop in the chat box the link to the estate planning and asset protection webinar we're doing next week. I think it's important that we have this stuff covered. Is estate planning is not just a will. Superannuation proceeds after dying is dealt with by binding death benefit nominations. If you don't have one in place, then it's dealt with under the trust deed. So maybe it may be, thanks, Steve. It may be actually really simple for the trustees to deal with it if you don't have a binding death benefit nomination in place, but it may be very difficult for them to work out what to do with it. So again, great advice in estate planning is what you need to be certain of this stuff and have these documents in place. Also, just a heads up, your estate planning costs, like your wills and estate planning and all those fees associated with it can easily be thousands of dollars. You can actually pay that from your SMSF. So keep that in mind. And we actually help our clients through this process ourselves, and they regularly pay if they've got an SMSF from their super fund to get this stuff done. In terms of the yeah, sorry, I did say that. It can be paid to the estate to be dealt with under the will. But if you don't have a binding death benefit nomination in place, it's not guaranteed. It sort of defaults back to the trustees. Also, a lot of people say, "Oh, I don't have any major assets in super or personally," and that might be the case. But if you've got an insurance policy worth hundreds of thousands of dollars or millions, then and you die, that's going to pay out. So all of a sudden, you could have heaps of money in super, and I mean, if it's you that's gone, you're probably not going to care too much. But if it's someone else in your SMSF that this is happening to, you've got to deal with that. So a massive asset and no documentation to guide you on it or give certainty around it. So, yeah, it's kind of little to no excuse to get this stuff sorted, and everyone's going to need a estate planning in place because one of the certainties in life is death. So it's just a matter of time. That's morbid, isn't it? But anyway, just please get it done. This stuff sorted, and with an SMSF, there's as I said, you can pay for the fees for it out of your super fund, and you can get all that documentation in place. Alrighty. Still happy to answer more questions. That's kind of the structured content finished, but I do want to share. I've got 1, 2, 3, 4, 5 case studies, and they're all kind of property focused. But the first one here is the vet from the bush. He held a commercial property outside of super. It was worth about 300 grand, and he had a loan from a lender coming to the end of its term for about 150 grand. So his net equity in that was 150K. He sold it into his super fund, paid a bit of stamp duty, and his super fund actually bought it, and he vendor financed the remaining part of it to his own super fund. So kind of how I said before, how you can borrow from yourself for a purchase like that. So you can lend bucket company money or money from a trust in. So his SMSF owes him about 150K for the purchase. And so he pays his 27.5K superannuation contribution into super each year and his market rate rent, let's call it 30 grand. So he's got about 50K going into his fund. And then he takes it straight back out as tax-free loan repayments. And he can do that until the 150K loan is paid back. So he's got quite a few years of that, where his superannuation contributions can come back to him as loan repayments. Again, the detail there is because he's loaned the money initially from his personal funds, not borrowing money from a bank. So he is pretty stoked with that scenario. Next one here. This was actually quite a few years ago. We had a client who had a commercial property outside of super worth about $1 million. He is shifting into retirement and he wanted to move more money and assets into super. So he actually transferred that $1 million property into super. He wasn't an owner occupier. I guess that's irrelevant anyway, but received rent for a few years at 0% tax because he was in pension mode. Within 2 to 3 years, he received an offer to buy that property for 1.3 mil. And because he was retired, pay no tax on the gain. So he earned 300 grand gain because he bought it for about 1, sold it for 1.3. So $300,000 gain at 0% tax, which is a great outcome for him. Next one there, the IT business in Melbourne. So this was actually a recent one. It was during COVID. The business was previously renting and has grown through COVID. The owner had an opportunity to buy a commercial property near his home for about 300 grand. It needed a bit of a fit out, not crazy, and that was funded. So the SMSF settled on the property. Didn't have tons of cash in it. It was sort of a bit of a young client in his early 30s, but he didn't have enough cash to do like a full fit out. So he actually prepaid rent for a year from his business into the super fund. Again, as long as that's market rate terms and all that sort of stuff, you can do that. So he prepaid the rent in and used that prepaid rent to go and do the fit out. The furniture was actually paid by the business to access the instant asset write-off. So all the desks and the chairs and the stuff the SMSF didn't provide, the business paid for that to get that tax benefit outside of super and own them outside. And then the client's now paying similar rent to what he was paying previously from his business, but now it's going to his SMSF, not a third party landlord. Cool. We got another one. I'll just give this will be our last one. And then I'll just finish the webinar because we are close to time. We had 4 business partners looking to buy office space, all had SMSFs, and all had 200 grand or so to put as a deposit down to purchase a 750K property. So they got 800 grand in cash in total, 750K property, plus the sort of stamp duty and that sort of cost of doing it. We used an ungeared unit trust because there was no borrowing needed or wanted. And each business partner just owned 25% through the trust, and the trust owned the property outright. So 2 of those partners are retired, and again, the net rent is being taxed at 0% for those 2. Just a different way of doing it without borrowing, which is again totally fine. It's all about the preference. Now, in terms of pricing, I did a couple of case studies. I do have one more that we can go back to for people who want to stay on afterwards. But I guess from our perspective, pricing on SMSFs, we do charge 3 grand to set one up, 3 grand plus GST. Your SMSF can, once it's set up, can reimburse you if you pay that personally as well. So the cost can come from your existing super funds. And then the things you need to consider is the ongoing cost as well. So we charge $250 plus GST per month for BASs if they're needed, administration, your electronic service address. So that's a requirement now of SMSFs that the ATO and your employers and Xero and payroll software communicates with your SMSF directly. It's pretty cool. So we provide that as part of it. Financials, tax returns, we've got an online portal as well that we can link clients up with, and SMSF support. So if you've got a question around a certain investment you want to make, and it's a phone call or an email away, we totally okay answering that. If you want to do a full-on property development structure session and things like that, that'll be extra, but the quick questions here and there are included. Other things you might need to consider with an SMSF, if we're going to help you, is a audit. So they're usually about $350 plus GST for the third party, 3.5K. Now, this is optional advice to advise on if you should set up a self-managed super fund or not. So I've only had 2 clients who wanted this in the last 6 years when they're looking to set up a super fund. Most of them come to us, already made their decision and just want us to implement the setup. But if you do want financial advice around that, we can't do it, but we can refer you to people who can help you with that once-off advice on if you should set one up or not, and answer maybe some more questions around your circumstances there. And then also the other thing that line is going over, unfortunately, is there we go. The last dot point there is the Bear Trust setup. So again, if you're going to go through a lending arrangement, we do have extra fees for setting up that like I call it the shadow entity or the Bear Trust, but that needs to be in place for you to purchase a property with a loan on it. And just rounding out the webinar, as I mentioned at the start, if you do have questions around the SMSF side of things, and book a strategy call in with one of our accounting team. If it's a bit hectic, I'll get on there as well. If you've got a crazy scenario, and there's probably nothing I haven't seen, so fire away. We've got Wealth for Life coming up. That's in January. So we just had our last one there. If that's of interest, we've got the estate planning and asset protection special webinar next week, which is so related to this stuff that we've been talking about. So do come along to that if you're keen. And then what we've got left is one more case study and Q&A. So I'll do that case study if there's no other questions. But yeah, thanks, Simon and Jermaine and Ben. Awesome. Thanks for coming along. I hope that was pretty informative and gave you lots to think about. Thanks, Wendy. Yeah, so good to see you here. All right, last case study. If there's any questions brewing, pop them in. But we had Andrew raised his hand. That was by accident, but Case study: service business in the building industry has grown through COVID. Existing home office hitting its limit and uncomfortable with staff in the home office with baby on the way. The client purchased an 800 grand property with a 75% LVR. It was a suburban zoned, half commercial, half resi. Needed renovations, and that was funded with super funds. Like the cash had extra money after settlement to fund that. And the furniture again paid by the business to use that instant asset write-off. I laugh, but it's great. The client now has a lovely shop front to take him into the next stage of his growth. So I think he's got the capacity to triple his business with that property there, and probably if he wanted to, even more than that. So really cool. That was probably about 12 to 18 months ago, that one there, or maybe 12. Cool. Thanks, Andrew and Mark. Appreciate the feedback. But yeah, doesn't sound like there's lots of questions. Appreciate that, Cara. Thank you for being on here. But yeah, that is about it from me. I'm going to have a sip of coffee and wait for anything if it pops through. But other than that, thanks so much, everyone, for joining, and I hope to see you. Hey, Junior. Oh, I haven't seen you or heard from you in a while. So good to have you on here. But yeah, awesome. All right. Well, thanks everyone for joining. If you've got any other questions, just shoot me through an email and I can get back to that as well. All right. Thanks everyone. Hope you enjoyed it.